Hello, I'm Graham Bibby, Chief Investment Officer, joined by Matthew Leon, Senior Investment Analyst. We're here on the 1st of March, giving you the view of what we're seeing in economies and markets and how we're positioned. When we last spoke in December, it was quite a negative time, and we saw markets really quite volatile in that period. We've seen in January and February quite a divergence again. So we saw a very strong January period in equity markets and then come back again in February. And we've seen a lot of volatility as market participants have just assessed what's going on. Just to recap on our views, Matt, what have we been talking about as our positioning and views?
Yeah, sure. So going into the end of last year, we were fairly conservative. Data since then has been more positive than what we expected, especially in Europe, where they had a milder winter, and they really didn't see too much negativity from any energy crisis. So that has turned us a little bit more positive, but markets have run ahead of themselves with a very strong rally in January. Now in February, there has been a bit of a pullback there, and bonds especially, we've seen them basically do a round trip in the last 2 months. Very strong rally in January, pull back all the way in February. What's our view there, Graham?
Well, we've seen both market participants and central banks responding to the data and really reading through it in a very different way. So initially we've seen some more positive data come through in earlier January. So what that meant for markets is that they were anticipating the central banks to pull back in terms of their interest rate hikes, so seeing an end to that cycle. And so that was quite positive for equity markets, and it was actually quite positive for government bonds as well. So a more benign environment. We saw credit rallying in terms of yields coming down, and we also saw government bond yields coming down. That then reversed as good data became even better in some respects, and good is actually bad, by meaning the central banks would have to hike rates even further. So markets again reacted to that, and we saw bond markets and bond yields go up as anticipating that higher interest rates for longer, which isn't really a great story for later this year. So maybe recap of what we've seen in company reporting, both US and locally. Quite a bit's come out over the last couple of months.
Yeah, so US reports on a quarterly basis. So we had the December quarter reports earlier in January, and Australia just towards the end of reporting season right now. So in general, we're seeing weaker earnings. That's actually coming from margins rather than revenues. So revenues have actually been stronger than expected. But what we're seeing across the board is that inflationary pressures have been an issue. Labour costs, costs for raw materials, fuel costs, they've all gone up and impacted margins. So what we're seeing right now is that earnings are slightly weaker than expected, but the outlook in particular has been a lot more conservative than what most people expected. So overall, we are seeing further earnings downgrades, and we did flag that as an expectation over the last few months. What we do expect is further downgrades to potentially come over the next 6 months. So that's something that we are looking at. We are very aware that the market tends to bottom before earnings bottoms. So we're continually testing our thesis and our views on this to ensure that we're adequately positioned for the risk involved. Graham, so apart from the equity markets, we have also been talking a lot about alternatives. What's our view on that at the moment?
Yeah, well, in alternatives, you can look at them from liquid alternatives, that is things that are traded in public markets, and in private markets. So in the liquid alternatives, we have some strategies that are performing, taking advantage of this more volatile environment. In general, some of these strategies work better and have worked better when we've gotten distortions from very low interest rates start to be relieved. And so hence we've seen some good performance from some of those strategies in the last year. We think there'll still be volatility that will suit some of those strategies, So it could be a good year for some of those, but not necessarily all. On private markets, speak to your advisor on that, because we've got an ability to offer non-advice private markets in a different part of the business, and talk to your advisor on that, and that helps to smooth volatility. I think overall we see that the mix of both the economy and markets and the view to the end of the year, we're going to see some opportunity to add back to equities gradually. We'll see some volatility and more downswing of equity markets from time to time. We're not saying that it's go fully back into equities yet, but just be careful and risk manage back into it, because we do see that markets price well ahead of the economic cycle. And depending on how that plays out, there'll be opportunity to add back a few times during this year. With that, good luck for the rest of the quarter, and hope that you are well. And please speak to your advisor and follow up with us.